lingering uncertainty surrounding the president's trade war has investors on edge, with historic sell-offs followed by record rebounds. So how should investors navigate the volatility? Joining us now, Ritholtz Wealth Management Chairman, CIO Barry Ritholtz, and author of the new book, How Not to Invest: The Ideas, Numbers, and Behaviors That Destroy Wealth and How to Avoid Them. Barry, I'm so excited to chat with you.
Thank you so much for having me.
So talk to me about how investors should not approach this moment. What should investors not do amid a trade war, amid record uncertainty?
So there's a little bit of it depends. Let's assume you're not retiring in the next 12, 18, 24 months, but you have a kid and you're saving for college in a 529 plan. You won't touch that money for 8, 10, 12 years, or you're saving for retirement in 10, 20, 30 years. You have to ask yourself, is this worse than the great financial crisis, the pandemic, the dot-com implosion in 9/11 that happened at once? Those were really horrific disruptive events, not just to the country, but to the markets, to the economy, and eventually you work your way through it. So don't engage your limbic system. Don't engage in that fight or flight response just to make the nervousness go away. You certainly can ask yourself, hey, am I really nervous because maybe I'm overexposed to equity? Maybe my portfolio is way too aggressive. But if you're not touching this money for 5+ years, you have to look through this administration to the other side. This is a chaotic, volatile mess, but we've been through worse, and we'll get through this, more or less intact.
It's interesting, Barry, especially given what FactSet was kind of noting at the start of this earnings season, which is, could you potentially see companies to the same extent during COVID-19 and the pandemic pull their guidance and issue to investors, signal to the street that they don't have clarity, and then that send more concern through the investment community, which is exactly what we're seeing play out.
Thank you for using the word clarity. I hate the word uncertainty because it's always uncertain. You never really know. But you generally have a sense. I think 2 of the big airlines that reported earnings,
Delta,
and JetBlue and South. So what they're seeing is all this soft data, sentiment data, starting to turn into hard data actions. So when people are at home thinking about booking a flight, you don't book a flight to go on vacation next week. You book it off in the future. Hey, this is crazy. I don't know if I'm going to have a job. I don't know what my bonus is going to look like. Maybe we should hold off on booking that family vacation to Disneyland. So everybody seems to be a little frozen in place. It's not just households. When we do see surveys that the Fed does and the Department of Labor and Commerce does of corporate CEOs and CFOs, what are your hiring plans? What are your building plans? What is your capital expenditure plans? What's your CapEx going to look like? Everybody is like, hey, we have to wait for the dust to settle to get some clarity, and then we'll figure out what happens. I'm not a believer that we can talk ourselves into a recession. That always seemed too cute. But if everybody is frozen because we have no idea what's going to happen, tariffs are on, tariffs are off, they're 10%, they're 100%, they're 25%. All right, we're carving out exceptions for iPhones and cars. Like, hey, when the dust settles, we'll see this is a very strong economy, at least up until April 2nd. When the dust settles, there's no reason to think it won't resume, assuming we don't have a really unnecessary, unforced error.
So how do you invest around that environment? And I keep trying to remind myself to flip it to the negative because that's your book.
How don't you invest?
Things.
Right.
And I wonder too if you can explain to me whether your advice or insight changes for retail versus institutional. This is something Scott Besson talked about yesterday, that retail is buying the dip and it's the institutional guys who are ruining everything. How does the advice differ?
So buy the dip works until it stops, and then you go through a period where, I just put out a market commentary on Monday talking about, hey, I know no one believes this, but the past 15 years have been amongst the best 15 years in the markets that we've ever seen. You have to go to the 15 years right after World War II and the 15 years that right before the dot-com implosion in 2000 for 18, 17 versus this 16% a year. And so when you're thinking about this, you really have to remember how much everybody hated the markets in the 2010s because the recency effect, because their most recent experience was, oh my God, the market crashed. Now their most recent experience has been the markets pretty much have gone straight up for 15 years. Yeah, we were down double digits in 2022 along with bonds. That hadn't happened for 40 years. And then, the pandemic, 17 days down 34% with a quick recovery. But buying the dip has worked, and it'll continue to work until it stops. We're overly focused on what just happened. So what not to do is recognize, just look at 2023 and 2024.
Yeah.
Back-to-back 25% years. We tried to do research on that. It's so rare that we had to use a data set of back-to-back 20% years.
Yeah.
And when you get 5-6 years of returns in 2 years, the forward expectation is, hey, lower your targets, reduce your expectations. In January, I told clients, if we see 5 or 6% this year, I'm thrilled.
Yeah.
Barry, it's interesting. In one of your answers a moment ago, you acknowledged two major technological disruption periods and cycles that we had seen in the past. Both within .com, we could add cloud within that as well. And they were eventually turned into show me stories where all these major investments and announcements were made up front, and then companies had to prove to Wall Street that they were actually able to grow into those multiples, that a lot of the hype phase sent their stock multiples skyrocketing over. Where are we at for the AI cycle within that too? Because that's where investors had really used that catalyst as a general thesis for their portfolio.
So everyone wants to pick the winner in whatever the new thing is.
Yeah.
So whether it's AI or mobile or genomics or go down the list of all the technologies that are driving so much of the economy. But we sometimes get hyper-focused on the Magnificent Seven, NVIDIA, when, we used to talk about internet companies. Hey, everybody's an internet company. Everybody lives on email, has a website, uses digital. And so when we look at the hype around a handful of AI companies, maybe we should focus less on the Magnificent Seven and ask ourselves, what are the productivity, efficiency, creativity gains from AI going to mean to the remaining 493 companies in the S&P 500? Potentially, it's going to make those companies more productive, more profitable, and more valuable. I think NVIDIA is the first company to lose $1 trillion in market cap, at least the first US company. So maybe they're the winner, maybe they're not. It's throwing a dart with a company like that. But you have to think about, hold what your Luddite friends are saying about, no, everyone's going to get fired and the world is going to hell. The way I look at AI is it's a collaborative tool that's just going to make all of us more efficient.
Barry, we've got 30 seconds left, but I want to get insights on Buffett and Munger. Cash holding right now, a huge thing of interest for our audience because of Buffett holding a bit of cash. Is he making the smarter move?
So he's a unicorn. Most managers that hold a ton of cash, you get a month where the market goes up and their clients are screaming at them. There are a few people in America named Warren Buffett who could get away with saying, hey, don't market time. He tells people just buy broad indexes, but I'm going to take some money off the table because I think opportunities are coming. Who's better than Warren? I mean, the average mom and pop investor should not try and do what Warren Buffett does. Literally one of a kind in all of financial history.
Barry, great to have you here with us today, and congratulations on the new book as well.
Thank you,
Author of the new book, How Not to Invest. We appreciate you taking the time in studio.
My pleasure. Thanks for having me.